right, welcome and thank you everyone for joining us for another Twitter Space. Today is September 14th, 2022, and this is episode 12 of the ledgerscale Internet of Value focus topic. Now, ledgerscale Foundation was founded with two goals in mind. One, we want to provide educational services to not only our community, but to the entire digital asset community, and to help scale up the number of brains that understand how distributed ledger technology works. And two, we intend to one day run hardware to provide infrastructural support to the distributed ledger technology networks that we believe are ESG friendly and running a form of decentralized consensus. We host these spaces Monday, Tuesday, Thursday, and Friday starting at 3:30 Eastern Standard Time, and on Wednesday we host a focus topic space from 5 to 6 Eastern Standard Time. And if I could just ask if everyone could give us a follow on Twitter and at ledgerscale and turn those notifications on so you know we're going live, and as well as hit the bubble at the bottom right and retweet and like the space to hopefully get this information out so other people can find it valuable in the future.
Yeah, so basically one of the main things we're here to do is just engage the community. So I'm going to try and do this automated market maker topic some justice. Hopefully I do a decent job. And but if you're curious about something, I'm going to try and leave some time toward the end. I guarantee you other people are. So just please ask up, be courteous, and yeah, welcome to the space. So today I was going to try and go over some of the AMM stuff. Does anybody have anything they want to speak up about before I just kind of jump into it?
I think it's good if you go over it once, maybe got everything you have that you're ready to say, and then maybe come up, people have questions, and then maybe we'll go over it again, and then maybe more questions.
Okay, well, just so everybody's on the same page, first off, an AMM is an automated market maker. So effectively what that is it's a pool that has two different units of value. So we'll just call it currency A, currency B. And then it's got some sort of mechanism that allows value to flow and change denomination between A and B. So that's the real core purpose here. It's different than an order book because in order books you have an order book. You have like a list of say limit orders and those are stack ranked, and then the highest bid and the lowest ask will cross each other, and that's how the pricing mechanism works. With at least the way I guess you could call them traditional AMMs. The way they work is I think it's based off of like proportionality of the depth of each side, but then there's a downfall. It's one of the reasons I've never participated in them. You have to deposit if you want to participate in a traditional AMM. You have to deposit value on both sides of the unit A and unit B. And if you don't want to hold unit B, well, you can't. Why would you do that? You wouldn't want to. And then the reason people participate and provide liquidity to these pools is because the pool takes a spread and they pay that out to the liquidity providers as like a form of a yield in essence, which makes sense. If you provide some liquidity, like if you loan someone money, you should get interest, right? If you're providing liquidity, it's reasonable to expect to get paid for that. Any questions there? And that's just kind of like what an AMM is. Okay. So one of the things that I don't like about the traditional AMMs is they introduce a new type of risk. And generally, if you're going to do a good innovation, you want to have a reduction in risk, or at least change the form factor of a risk so that it's not as scary. And so they actually introduce a new risk, which is going the opposite direction. called impairment or impermanent loss. So the idea with impermanent loss is, let's say, let's take XRP and Bitcoin. So you got a pool with XRP and Bitcoin, and all of a sudden, and you've got an equal dollar amount. You got $100 of XRP and $100 of Bitcoin, because you have to put in an equal amount the way these old ones work. And then XRP goes through the roof, and Bitcoin hums along. So now your portfolio balance has very few XRP, because you're only going to have $100 of XRP, but you got more Bitcoin, which didn't go. So you lose out on all of that gain had you just held the XRP and it went up. So it's like an opportunity cost type style risk. And I just don't like introducing new risks. The world's risky enough. So that's always bothered me with these old ones. With this proposal that David's put out, you can actually only supply liquidity to one side of the liquidity pool. Now, there could be benefits to supplying liquidity to both sides in terms of reduced cost, but you at least have the option to only supply liquidity to one side. So I think Stellar has something that enables that. I don't think it uses the same mechanics here, but I need to study up on that one too. But this is a big deal, because by enabling a person to only supply liquidity on one side of the AMM, you completely get rid of the impermanent loss. It's gone, just disappears. So that's good. Getting rid of risk is good. Does that make sense, or am I going too far? Good. Okay.
Yeah, good.
So that's a big advantage to this setup. Now, the other thing that I think I'm starting to get a better grip on, and don't shoot the messenger here if I screw some detail up, because it is a rather complicated function. So the way that this proposal, this XLS30D, it creates I'm assuming people here know what a black hole is. Basically, you set up an account as a liquidity pool and you black hole it. So nobody has control of it. It's just there. It's going to function however it was configured, and that's all it's going to do. But it does issue these liquidity pool tokens. So if you think of like A and B on either side of a teeter-totter, the liquidity pool token is like the fulcrum. It's like the balancing component that keeps the system in balance. Because what happens if a bunch of people take value out of A? Now you've got a lopsided pool, so maybe there's only $100 of value of A, and maybe there's $200 of value of B. So the liquidity pool token helps balance that out. And one of the other things that and so there's a lot that goes on with this liquidity pool token. Like in terms of a balancing tool, it does a lot of heavy lifting, actually. So one of the things, all right, so in a liquidity pool, so I want to try and think about this from various perspectives. So you've got a liquidity pool. You have people who are going to be arbitragers. Okay, they're going to probably be like your institutional professional guys. You have your liquidity providers, right? So that's people that deposit, currency A or currency B into the pool. And then you have consumers of that liquidity. So somebody who's just trying to make a payment from A to B or B to A. either which direction. So you want to look at these. Well, the liquidity pool tokens really only matter, if I'm understanding this right, to the arbitrager and the liquidity pool, like the liquidity providers. Is that making any sense yet, or am I getting too far ahead of my skis?
No, keep going, keep going.
Okay, so with the liquidity pool, by owning the liquidity pool token, that's how you earn your rewards for providing liquidity. Then, and that's kind of less interesting to me, but that's just how that. So you make your deposit into the pool, you get the tokens. The tokens give you access to rewards. You collect the rewards. I'm pretty sure the rewards are paid out in liquidity pool tokens, so you can kind of compound there. It's a pro rata or a proportional share. So if there's like 100 tokens and you have, I don't know, 10 of them, you're going to get 10% of the whatever the reward is. So I think that's how that works. That's not so complicated. The cool stuff comes in on the arbitrager side. So each liquidity pool has what's called a slot. It lasts 24 hours. And for some reason, it's cut up into 20 chunks. So I don't know how many minutes that is, but I guess that's easier for round math and stuff. So if you want to, and so what happens if you own the slot, like if you buy the slot, you're an arbitrager, right? So if you buy the slot, you have decreased trading costs, which means you can make more arbitrage profit. So that like gives you an advantage, obviously. So you buy these slots, you have to pay for the slot in the liquidity token. Hold on, I'm going to get ahead of myself there. Okay, so the arbitragers buy the slot. If like say Death buys the slot from me, and I just because he's willing to pay more, then I get, and let's say I've got 5 of the 20 segments of time, units of time left. I get compensated for those. He gets to be arbitrager for those 5 slots, and then the rest of the liquidity he has to pay. He has to buy that slot, paying in liquidity pool tokens. So he can either buy the liquidity pool tokens on the open market, creating demand and increasing the price of the liquidity pool token, or he can earn them, I guess, by depositing liquidity. So he buys the slot off of me. Now I'm out. I'm no longer arbitrager, and I don't get to like negotiate this. If he's willing to pay more, then he just takes the slot. So I get compensated for the time I had remaining. The rest of the money is burnt, effectively taking the economics and distributing it proportionately to all liquidity pool token holders. So the guy who gets bought out. Everybody else gets the benefit because the tokens are burned, thus reducing the supply of liquidity pool tokens. Does that dynamic make sense? All right, I'm just gonna keep going. I don't know, man. Somebody raise their hand or something. Or
Yeah, so I'll start sending some invites out. If anybody, I'm sure somebody in the audience has a question about something specific that you've said so far, and so I'll bring a couple of people up. If not, just keep going on with what you're thinking.
yeah, I mean, yeah, I'd rather go ahead and address something while it's fresh. If somebody has a question.
Yeah, I agree. It's easier to go back, go over something, than keep going forward and keep going back over things.
Yeah. Sorry, I'm just approving a couple of people. I mean, I've already feel like I've gone over quite a bit, and none of that's exactly like anything that I've ever seen in finance before. So it's one thing if you've seen something before and it's like, oh yeah, it's another one of those. This is not another one of those.
And if you guys have some questions, go ahead, Focus.
Yeah, hi, Karma, hi everyone. Regarding to you've been talking about that automated market maker thing. The liquidity token is something what I'm missing actually. Is that token to be like stable coin or something, or?
No, it's specific to the liquidity pool. So if you have liquidity pool number one that has, say, Bitcoin and XRP, and you have liquidity pool number two that is, say, Bitcoin and Ethereum, and liquidity pool number three that is two other things, each one of those liquidity pools is going to have its own liquidity pool token specific to that pool.
Get it now.
Is there a ratio for it? Do you know yet? Like when you deposit the one side, is there do we know if there's a ratio yet?
There's an additional cost to only participating on one side. I don't know it off the top of my head, but if you contribute equal value amount to each side of the pool, then you basically don't have to pay certain trading fees.
Mm-hmm.
Versus if you're only participating on one side of the pool, then you get dinged on some fees.
So
part of the reason for that is you get dinged in liquidity pool token, I believe, because that's the balancing act. Is the liquidity pool token does that. It does a lot. I mean, the liquidity pool token does a lot of heavy lifting. Quite from a functional point of view. Seriously, that's one of the many things that it does. Is by charging you fees, what it does is because if let's say you deposit or withdraw XRP out of an XRP Bitcoin thing, well, you just change the ratio of XRP to Bitcoin in that liquidity pool. So the amount by which you changed it is compensated for with trading fees, I believe, that are denominated in the liquidity pool token.
Yeah, that AMM functionality is that might work without the hooks, or that's related to the hooks?
No, it'll work without the hooks. It has nothing to do with hooks.
Yeah, so I was really excited to start messing with the Aqua protocol, the liquidity protocol on Stellar, but it is like the way you're talking. This is absolutely different. Like it's not even the same thing. So each pool has its own liquidity token. But do we know is that going to be like a Bitcoin XRP? If you cash out between that pair and you cash out with Bitcoin, is the liquidity pool token, is it defined by which end you withdraw out of, or
think of it almost like this is a terrible analogy, so be warned. But think of it almost like what do you call the person that manages a trust? Because the liquidity pool token gives you voting rights to vote on fees. The liquidity pool token, if you want to be an arbitrager, you have to buy that slot in the liquidity pool token. Like if you want to be the arbitrager for the next 24 hours, you got to buy that slot, and the only thing you're going to buy it in, is liquidity, is the pool's token. And then if nobody has the slot, then all the money you pay, all those liquidity pool token or LP tokens, they all get burned. So effectively, you paid the entire pool a pro rata share of, because the tokens are gone, right? So they're out of the supply. And so I think that's economically sound. And then, like, if I come along and buy the slot halfway through the year or halfway through the day, I mean, you get compensated for the back half of the day that you didn't get to be the arbitrager because I took it from you. And then the other half of what I paid gets burned. So effectively, it gets paid to all the pool holders. So it's a very equitable arrangement, I think. You're not screwing the guy who's getting bought out, because he bought say 20 units a time. If you're going to buy 10 of them, well, he should get paid for the 10 units a time he didn't get to be arbitrager. That's reasonable. And the other amount of money you paid, because it's burned, it just kind of effectively gets distributed. It's almost like XRP getting burned. Like every time people burn XRP for a transaction, like every XRP holder technically gets a little more value because there's just less XRP. If that makes sense.
Yeah. It's just very different. I was hoping for something similar so I could jump right into the ledgers AMM. One of the big differences from the Stellar AMM is that I don't think Stellar has ever announced that they back it or they promote Ultra Stellar at all, and I haven't heard anything about it. As far as like who runs it, no idea. But this is coming straight from XRP. This is being built by the foundation, or is that what's happening?
I'm pretty sure David is the brains behind this one. I'm sure there's more than just David. There's the lady, I forget her name. She's head of research. She did a presentation on it at Apex. And there's another guy that I messaged, but I probably should have given him more of a heads up, that did another presentation on the AMMs at Apex. And I was shocked, man. This is way further along being developed than I would have thought. The Omar had he's got a whole front end, UI, UX, the whole 9 yards already there. So you're not even having to go in like command line and stuff. They've already got a desktop browser interface to like set up a liquidity pool. He set one up, did some transactions and the whole thing live. This is way further developed than I expected, and I think that David said something. Maybe they'll have it out on DevNet or on the testnet by October, which is just a couple of weeks away.
I wish I had more to ask, but it's completely different. One thing I did want to clear up. So from my understanding, like AMMs, they're really only good for maintaining the current price because you're giving liquidity from both ends. So it really keeps, if there are a lot of active participants, it keeps the token at a stable price, doesn't it?
The arbitrager's job is to maintain price parity between, say, like, okay, so Bitcoin obviously trades on the Bitcoin ledger. And so you would want to maintain, and let's say you had a dollar stable coin on the XRP ledger. So you had a liquidity pool between Bitcoin and dollars, right? The arbitrager's job is to make sure that the exchange rate, the liquidity pool token is, they're going to be the one providing the exchange rate. So to make sure that matches reality, because you don't want to be able to go on, say, Coinbase and buy, Bitcoin for, I don't know, 50 grand. And then you can go on this AMM and get Bitcoin for 45 grand, right? The arbitragers are going to close that $5,000 gap. And they're going to make a profit doing so, right? Because they'll go on the AMM and buy driving the price up from 45 to 50. And the whole time they're buying under 50, they're going to be selling on Coinbase. So they're buying at 45, selling at 50, buying at 46, selling at 50, buying at 47, selling at 50, and they'll drive the price back up. That's their rule from like a market mechanics perspective. And they have to pay for the right to do that. Right? They got to buy that slot. And in order to buy that slot, they have to have liquidity pool tokens. So this means the liquidity pool tokens have intrinsic value, like they have real economic value, because what that slot earns you as an arbitrager is less fees, which means you can be more competitive than the other arbitragers, which means you win. You make more money. You can offer lower spreads. Because you can offer lower spreads, the AMM has tighter spreads, and tighter spreads are an indication of a healthy market. When you see like 08, when spreads blow out and the markets freeze, okay, this is like a heart attack for a market. That's terrible. You want a healthy market, has tight spreads, deep liquidity. That's in all of these mechanics, that the way this is designed, I think in total, I think we'll create a system where everybody's incentivized to keep the spreads tight. There's incentive and reason for the liquidity pool tokens to have value. One, if you hold them, you can earn a yield. Two, if you hold them, you can buy a slot if you're an arbitrager. So maybe you're a little more sophisticated market participant. That's two different types of value creation or value backing the liquidity pool token. You got cash flow, and then you got opportunity, if you're capable of executing on the opportunity as an arbitrager. That makes sense?
Correct me if I'm wrong, because supplying liquidity for both sides, let's say XRP to Bitcoin, you need to have a collateral, yes, both sides. And that's pretty much destroying the argument for people who are saying, oh, the price of XRP can't rise because it's just 3-second transactions. So that's my quick thought about it.
I'm not sure I understood that. With this AMM proposal, you can, if you choose to, participate on side A, side B, or side A and B. So you have three options there. You can do one-sided, pick a side, or you can do both sides. And you can do both sides, but you don't have to do so proportionately. Maybe you only want to put $75 of currency A and maybe $100 of currency B. Right, you can do that too.
What I was saying, that there was a need to put a specific asset into like kind of collateral, right?
Well, when you deposit, if you're a liquidity provider, then when you deposit the value into the pool, then yeah, you have to send the money to the pool. Yeah.
Yeah, so that's pretty much means like all XRP, let's say in supply, there will be some of them will be locked in the collaterals.
Well, they're not locked like an escrow, so you could put them in this morning and by this afternoon say, nah, I don't want to do that anymore. Give me them back. So you're in control of that.
Yeah.
All right, any more questions on that, or I'll kind of chug forward a little more. I'm hoping to leave at least 15-20 minutes at the end. Okay, so this is one of the cool things, because I didn't quite get this when I was talking to David, and I could see his hand gestures, as he was talking about how, okay, keep in mind all the stuff I just said about the liquidity pool and the arbitrageurs and all of this. and like they have to buy the slots and everything. And then, so when he says, so this is a market dynamics thing. So I'm going to say this from the arbitrager's perspective, and then I'm going to try and say it from the liquidity provider's perspective. So you have the volatility, right, in the market. Yay. The arbitragers, the more volatility, the more profit they can make. So that's good. Okay. From the liquidity pool's perspective, you want to have a very accurate pricing. So if the pool itself as a thing is functioning properly, it really, I mean, it should follow the volatility of the value between the two assets, but it really shouldn't deviate too much from that. That's the arbitrager's job. But if just the fact is that the market's going up and down and all over the place because it's crypto, then what happens is from the arbitrager's point of view, it drives up the value of the slot, right? Because if you got a market and it's like dollars for dollars, well, there's not a lot of volatility there. Like, I'm not paying a whole bunch of money for that slot. Why do I want to be the arbitrager between dollars and dollars? Like this, what am I going to make there? So the more the volatility, the more valuable the slot, because to the arbitrager, because they can make more money, the more valuable the liquidity pool token. And then there's a competition between the arbitragers. So ultimately what happens is whoever has the lowest cost of capital wins. Line of credit could come in there, but I don't want to go down that rabbit hole. Not on this chat. That's too long of a rabbit hole. From the liquidity pool provider's perspective, what happens is with some of these other AMMs, it's the pool operators basically taking the profit out of the liquidity providers' pockets. In this way, because the liquidity pool tokens are burnt, then it's not exactly taking the value, this out of the portion of the spread out of the liquidity provider's pocket. And there's another mechanism there. Oh, what is it? I think it has to do with the dynamics of the liquidity pool token going up and this price of the slots going up. Because when the arbitrager buys the slot with the liquidity pool token, the portion that's burned, if you think about it, is actually a chunk of the spread, right? So that drives up the cost for the arbitrager. So by driving up the cost of the arbitrager, you're shrinking their spread. So that sucks for the arbitrager. But the part of that sucks for the arbitrager benefits the liquidity providers in the pool. So you have the arbitragers engaging with the pool, but not necessarily in an adversarial way to the liquidity providers, because the arbitragers are paying for the right to own that slot, and part of the money they pay goes to the liquidity providers, right? So there's a good balance there. I mean, this thing really is pretty elegantly designed from like a financial engineering point of view. And I still don't think I've fully got it in my head.
Is there a time limit to buying an arbitrage spot? Like is it can you have multiple orders, or is it once the order's closed?
There's each slot is 24 hours long, and I believe you just basically don't have to pay the trading fees. So that's your advantage. So you're buying the advantage of reduction in cost. That makes sense. If you're the arbitrager. And each 24-hour is cut up into 20 segments of time or units of time. And so that's how it goes. So you buy your 20 units of time. If you use up 15 of them and I come in and I outbid you and I buy the other 5, well, I give you the money back for the 5 that you didn't get because I took it from you. And I've got 5 units of time of that slot. And now I'm the arbitrager, and hell, you could outbid me and buy them back, right? And this creates good market dynamics for the liquidity pool token. Every time there's one of these transactions, more liquidity pool tokens are burnt. The more liquidity pool tokens are burnt, the more everybody has a larger percentage of liquidity pool tokens or of the pool, right? Because if you keep having these arbitragers burning liquidity pool tokens, you know, your percentage of the liquidity pool keeps going up because it's based on your percentage of tokens, of LP liquidity pool tokens. I mean, the dynamics are really, honestly, are set up quite nice. It's taken me a little while, and I still don't feel like I fully got it, but think I'm getting there. And there's this liquidity pool token design is really doing a lot of heavy lifting. It's balancing out multiple things. There's also voting. I haven't even really gotten into that, so I don't really want to speak to it. But yeah, it's impressive. Let me just run through a couple other things and then I'll shut up. I just want to one other thing that David was saying was that, I'm not sure I can explain this quite right, but there's like I would call it asymmetric. He called it geometric payoff. So let's say you compare situation A where you hold XRP and that's it. You just hold it. Situation B where you hold XRP and you put it into a liquidity pool. And then let's say XRP goes up 10%. On the XRP you hold outright, you're going to go up 10%. On the XRP in the liquidity pool, you're probably going to only go up 7%, roughly. I'm making this number up, so don't take me at that. And the reason why is because, so the liquidity pool, when it harvests, the word he uses is harvest volatility. Part of that is because when the thing's going up, it's going to be selling, let's say, XRP and Bitcoin. It's going to be selling XRP relative to Bitcoin, right, to maintain the price equilibrium. So since you're selling on the way up, like by the time you get up, you're going to have, the pool will have less XRP, so you don't get as big a gain. The part where I'm not quite sure I understood is he said, okay, so let's say it goes up 10%, the market goes up, spot market goes up 10%. You're in the liquidity pool, so you only got a 7% gain. But then it goes back down 10%. And for some reason, what he was saying is the way the math works out is you went up 7%, but you only went down 5%. So having done the round trip of going up 10% and down 10%, you're still up 2%. So there's like a bigger payoff if it goes up than cost if it goes down. Now, if you just hold the XRP outright, then it went up 10% and you went up 10%, and then it went down 10% and you went down 10%. But if you're in the liquidity pool, when it went up 10%, you got 7. When it went down, you only lost 5. So you're back in the same place with XRP at the same price, but you're up 2%. And I'm assuming that's probably from the payouts from the liquidity pool, right? I mean, because that's going to give you some kind of cash flow from having provided the liquidity. You know, I mean, you did your job, you provided the liquidity, right? So you should get compensated. So I'm guessing that's why you end up with 2% at the end of the day, even though the price ends up right back at the same spot. Does that make any sense?
Yeah, I think it's more so added to the fact that there's no time delay between order books and AMM being able to execute. And so, with having the higher speed transaction flow and low cost of transactions, it allows you to come out on top.
Well, there's that as well, but that's more an element of how would this AMM be competitive against other AMMs? And, you know, for the other AMMs, like if they're like built on Ethereum or something, like, you know, they just have to deal with the disadvantages there. Doesn't mean that AMM is designed. I think this AMM is designed in a more superior way. That's my opinion, having looked through it. Than the kind of traditional AMMs. I think they're a little more not as sophisticated.
The rewards are a percentage of the total locked value in a pool, right?
I think the rewards are paid out in liquidity pool tokens. So, see, this is one of the things before I started understanding the slot mechanics. It was like, okay, you're going to pay me in liquidity pool tokens, but who the hell cares about liquidity pool tokens, right? Nobody cares.
Well,
Well,
the more tokens you have, the more you can participate. So, like with Aqua, you're rewarded with Aqua because it gives liquidity for both pairs, and then they reward you after each cycle with whatever percentage. Like if it was only 10,000, you would get 2% of 10,000 spread across all the participants. And then they also have other functions that give participants more of an incentive to to find that favorite pair or the pair that they want to continue working with.
yeah, I think that actually I should probably double check that. But I think it pays out the rewards denominated in liquidity pool tokens. So see, when I finally realized the arbitrageurs have to buy the slot in the denominated in liquidity pool tokens, then I was like, okay, right? Like now I understand, because if you're just giving people LP tokens, why do they have any value, right?
So
Like,
here's the most important thing for people who live in the United States. So there's no tax liability with that. So you're giving an LP token, which is just basically a reward or an IOU to future claim of more tokens. And so if you lock yourself up with this liquidity and you provide liquidity and essentially receive these LP tokens, there's no tax liability with receiving the LP tokens until you would say change them back into another currency.
yeah, I saw David say that. I'm not 100% sure I understand the thinking behind that, but that would be freaking awesome.
Yeah, until you would trade them back from an LP token to like your XRP or whatever. Technically, there's no taxable event that should happen. But I'm not a CPA, so ask your CPA. But yeah, I mean, it makes sense to me.
Well, really, you're just by receiving the liquidity pool tokens, what you're doing it's almost like, let's say we had a partnership, and every year, we got paid in like an extra percent of the company, right? Because the more of the liquidity pool token you have, the larger percentage of the pool that you sort of have. I probably need to reread that section. I'm telling you, this thing is not a simple amendment.
Is there a time limit on the pools you're in? Like in Stellar, I think most pools give you like a 3 month. Yeah, I think 3 month is the max for any pool, and then they send you back your LP tokens, and then whatever, in that time I think it's like every couple weeks it'll send you your reward, or every cycle. I'm not. I haven't really read it.
Yeah, so
But that's about how it is. Like the pool, there's a time limit. You can't just set your whole pile in there and then walk away, and it'll come back to you after that time limit.
and that was built by whoever wrote that smart contract. So Stellar XLM has the ability to have smart contracts on it, right? And so that AMM is just a smart contract somebody created and built the UI on top of and stuff. And so they set the rules in that sense, where this, if it went live on the XRP ledger, would still be fully decentralized in the sense that the AMM is not owned by anybody. It's part of the layer 1 protocol, and anybody can use it. And so it just works. So that would be the difference in the sense of that might be a DEX, but it's not at the same time, because there is a centralized entity behind the DEX, which is in all cases for every single smart contract, like you name it, Uniswap, right? There's somebody behind those singular smart contracts and access to it.
And there's no I'm pretty damn sure there's no time. See, time is something that catches my eye. So there's no time. You're not locked in to anything. You're not locked in. The arbitrager is not locked. The liquidity provider, is not locked in. The arbitrager is not locked in. The liquidity consumer, who's just tapping this pool of liquidity to fund a payment or something, they're not locked in. Everybody can come and go as they please, and I think that's important. That's
the penalty for exit, like if you exit out 10 minutes afterwards.
That's fine. Whatever. I mean, fine. You can pull your liquidity out, sell the liquidity pool tokens, and yeah, cool. Why not? When you start locking money up, what you're doing is creating risk, and that's generally a red flag. Like I said earlier in the chat, it's best to most real, true, like big time innovations actually reduce risk in some goofy way that nobody thought of before. Adding risk is not desirable. So yeah, nobody's locked up. I mean, I guess you're locked up for like a ledger close. What's that, 3 seconds? 4 seconds? The arbitrager, I guess they're locked up for their 24-hour period unless somebody buys them out. But they should be making.
What's the 24-hour time frame on the arbitragers? I really like that, because it won't allow like insiders to like, if someone has insider information, they can't immediately jump in or they can't sit there and they can't take advantage of insider information with just a 24-hour window. I think that's a good thing.
Well, there's two things to that. One, they can buy the next 24 hours, right? They can buy the next slot.
You can pre-buy? Or
I think so. I don't know. I've got the thing open right here to that page, but I don't know. And the other thing is, it doesn't matter. Let's say you bought the full 24-hour slot, so you got all 20 segments of time. I can come in at any point during that 24 hours and just buy you out, and you can't say no. Like, if I'm willing to pay more, then you just get your money back for the amount of units of segments of time or units of time you have left, and the rest that I paid where I outbid you, that gets burned. So effectively, the value goes to everybody that's a liquidity provider, and now I'm the arbitrager, and you can't. There's nothing you can do about that other than buy me back out, right? Now you can pay more than I paid, and then I get my money back, and the extra money you paid gets burned, and everybody that's a liquidity provider benefits from the burn. It's really a pretty cool market design. I mean, I've never seen anything like this.
I'm excited. Thank you guys. This is Karma. This is a lot of info. Appreciate it. I'm going back to listener.
Well, we're getting right about to that time. Does anybody else want to pop up with a question? Let me check my notes. I think I went over my list.
So super noob question.
Cool.
And so will the AMM be, I guess, a large factor in sourcing, like in these financial institutions sourcing their XRP liquidity that they need for their transactions, or will that all be obtained directly through agreements with Ripple?
Yeah, very well could. Very well could. I mean, because see, once you have these AMMs, now you have sort of three core functions or methods of moving liquidity around the ledger. You got trust lines, so like that can go direct peer-to-peer payment, like wallets. You've got order books, so that can be a conglomeration of wallets, but you're using the order book method, and then you'll have these AMMs. And so yeah, there'll be three different methods of or methods, I guess, that a consumer of liquidity could tap.
I had to ask because I was reading through like an ODL. I'm not sure what documentation or article it was by Ripple the other day, kind of seeming to explain it. And what I got from it was this idea that the initiating institution receives the XRP on credit and then is required to pay it back within 7 days. And so what I gathered from that is that the ODL mechanism is separate, like a separate source of liquidity for payment rails.
ODL can source liquidity from like the exchanges, so that's off XRP ledger liquidity. ODL could also use line of credit, which I believe is probably going to end up using payment channels, but I don't know about that. They haven't really been public about that, but I don't know how else they would do it. So yeah, ODL is more of a service you're going to go to Ripple to obtain. AMMs, order books, and trust lines, these are on Ledger. You don't have to screw Ripple, right? You don't need to talk to them. They don't need to know. It's completely irrelevant. You can just use the functions on the Ledger, and that they're there.
Yeah, that's the big. I think that's the biggest difference between every other AMM that exists today is that there is no other AMM that will exist on a layer one blockchain, especially attached to a DEX with an order book.
So then, in regards to my questions and being a source of liquidity, the AMM might be better for like SMEs as opposed to larger financial institutions. I have to ask these questions because it seems to me that there's like a lot of rhetoric and potential hype within the XRP community. This idea like of all the money and that banks will be buying XRP from consumers or from retail, and that will drive the price up. And I don't really think that that's accurate. From what I'm
If banks are
understanding.
going to do anything, they're going to most likely use the line of credit. So, just for round numbers, they'll go to Ripple, they'll establish a credit facility for, I don't know, $100 million worth of XRP. They'll pay 1% to Ripple for the fee on the line of credit. They'll charge their customer 2%, and they're happy.
Also, I don't think retail owns XRP.
What's that?
I don't think retail owns a lot of XRP to begin with. I don't think there's not a lot of them.
The only measure of that would be the depth of liquidity on all the exchanges, because that's primarily going to be retail action, and ODL can alternatively, outside of line of credit, well, even if you use line of credit, you still ultimately are kind of tapping the exchanges. So the exchanges are a big key piece of the puzzle. I mean, that's where, like, this whole AMM thing, it's all about currency A and currency B. Well, what do exchanges do? Currency A, currency B, right? Now, they run the order book method instead of the AMM method, but it's the same core function. You're changing the denomination of the value.
So that being said, it may be exchanges who utilize the AMM, not necessarily as a primary customer, but as a potential large user of the AMM functionality in order to facilitate um, cross crypto payments, perhaps more efficiently, cross chain.
It's an interesting thought.
In a perfect world, but exchanges are lazy. They're there just to collect a piece of the trade on the up and the down on their own UI.
Well, but see, they wouldn't. They would probably have some hesitancy to do that because, in essence, they would be cannibalizing their own core functionality, which is the exchange, right? The AMM is an exchange mechanism from unit A to unit B. That's what they provide.
Yeah, exactly.
So you'd have to think that there's probably something to what you're saying, though.
Yeah, I mean, because if they can do that cheaper for themselves and then, or charge the same amount or perhaps slightly more for it as a fee, then it would be beneficial to them. But I think coming back to what Death Ranger said, that makes sense as well. Gosh darn, perfect worlds.
We're getting a little over. I know you had some things to take care of. Do you want to stay on for a little bit, or do you want to wrap it up?
Yeah, you can keep going.
Okay. I mean, I think we could probably do another topic, another focus chat on this topic. It'll be. I'd like to get Omar on. I think he'll do better than me for sure. This is just a big topic. I mean, there's a lot of dynamics going on here.
Yeah, does anybody have any more questions on it, or anything they'd like to say about it?
I think it's just kind of hard to wrap my head around, right? I mean, I barely understand an AMM as it is, and to take that to the layer one DEX connected level it's almost beyond comprehension at this point to even imagine for me.
Yeah, and so take the XRP ledger, right? 10 years in the future, okay? All right, so that's where I'll put us right now. All right, so you have these federators, right? Federators connected to alternate side chains and exchanges, and maybe you could even think of this as like being able to be connected to ODL if you needed to, right? They have all these different federators connected to different things. And this AMM, which can act as a liquidity provider attached to the DEX, which has an order book that it can control. And so you essentially, if you mix some AI into this, you essentially have an automated multi-chain system where you could have, simultaneous things being provided liquidity for wherever it needed to be, when it needed to be, and so much more of efficient of an ecosystem. You could think of it as an global financial market. I mean, that's like, as efficient as you could possibly get in my mind.
But where are the price points coming from? Maybe this is something that was already discussed, so I apologize if you've already gone over it. But
Price point of what?
So for the exchange of another cryptocurrency, it isn't XRP or
that's the arbitrager's role.
Gotcha.
If there's a price discrepancy between the exchange rate on the AMM and say the exchange rate on some other market or ledger, then let's say it's Bitcoin USD. I used this example earlier. If it's $45,000 for a Bitcoin on the AMM and you can sell them for 50 on Coinbase, well, you buy all Bitcoin all day long on the AMM and just keep selling it on Coinbase. But
Gotcha.
eventually, the arbitrager's market activity is going to drive the price up to 50 grand on the AMM, and then the AMM will be back at parity or equilibrium with the Coinbase market. So that's the mechanic there.
Wolf, I see you have your hand up. I just wanted to finish this so I can kind of get an understanding. Kind of coming back to what Death was saying. So then the sourcing of those prices, right, across the various exchanges and points of sale, I suppose, for the different cryptos, that's the responsibility of the arbitrager, and something that could be benefited, enhanced by the use of some kind of AI or Oracle to automatically receive those prices.
You're going to want to automate that. There's no way you're going to do that manually. Yeah, that's obviously going to be some code. There's some guys I know that have done this kind of stuff. I'd love to work on this kind of thing, but you got to be able to write code for that and automate it. I mean, you need to know what formulas to write, of course, but it's a competitive. So, the better people get at it, the smaller the opportunity, right? Because people keep chipping away at that spread, and that spread keeps getting narrow and tighter, and so you make less and less money per trade, and that's just how competition works. And by making less and less money per trade for the arbitrager, the consumers of the liquidity get a better and better price, right? Because the spread's lower. So they get a more accurate and fair, so the arbitrager's loss of spread is the liquidity consumers gain in reduction in fees.
And a healthier market by a tighter spread. Based on, coming back to what you were saying earlier. That's cool, man. Wolf, you got your hand up.
Yes, thanks, Karma, so much for informing us today. It's been a lot of useful information. As Samsa says, it's a little bit, to understand everything at once. But I just have a question about the liquidity token or the liquidity pool token. How will it be distributed, you think? Will it, just be made, and how?
Well, can you say that again, Wolf?
I think that when you put your deposit, like when you deposit your liquidity, it will calculate what percentage of liquidity you put in. And I need to double check this. I hope I'm not saying something wrong. But it looks at the percentage of, like, say it's $100 pool and you put in $10. Okay, now I think that comes out to like 9.9 or something. But then it'll give you, it'll print the number of liquidity pool tokens to give you your proportional share of the pool. So it's all just proportional. If you're the only guy in the pool, you're going to have all the liquidity pool tokens. Somebody else comes in, now they're going to get some liquidity pool tokens, and you've got the same ones you had, but now you're not the 100% depositor. Like, I put some money in too, so I get some as well, right? So you put $100 in, and I come and put $50 in. Well, you'll have 100 liquidity pool tokens. I'll have 50, right? So you went from having 100% to a third, or 2/3, sorry, and I got a third when I put in my 50.
But is there like a universal liquidity token, or could it be different from pool to pool?
Yeah, each pool has its own token.
Okay.
Yeah, each pool is basically like a wallet, and then it's set up as a liquidity pool. It's black hold, so no one can screw with it anymore. And then it just functions as a liquidity pool account, and it issues and redeems the liquidity pool tokens. So like when like say an arbitrager buys a slot, they send the liquidity pool token back to the issuing address, liquidity pool address, and then they're gone. Right? They're out of circulation. They're burned. And so, yeah, each pool will actually technically on Ledger be effectively an address. And each one will issue its own LP token.
All right. LP token is, yeah.
It's just a representation of your value locked up in the pool. Is an easy way to think about it.
Yeah, that's fair. Because, you get a proportional share. Like, if there's 100 units of value, doesn't matter if it's A or B, and I put in 5 of them, well, then I got 5 LP tokens out of the 100. If that percentage changes because withdrawals, deposits, other people, yada, yada, then, my proportional share, like the value of that LP token, it just sticks with whatever percentage of the pool that I've contributed to. The only outlier being, if I'm an arbitrager and I want to buy a slot, well, I got to pay in LP tokens. So that's kind of like me paying because they're burned. That's kind of like me paying all the other people for the right to have lower transaction fees. And, you are providing a service when you do arbitrage. You're providing liquidity. So, and data flow. So, these arbitragers are basically going to be paying for the right to service the pool. It's almost backwards. Like the pool should the pool does kind of pay them because they make their arbitrage profit. So it's really a well-designed setup.
One more thing. The side chains, is that the amendment that will be voted on when that time comes? Because since you say that the AMM will be on a side chain, so when?
So I'm not 100% sure if the AMM would be on the side chain. I'm pretty sure if it's going to be voted on, it has to do something with the layer 1 protocol, right? Because if the side chain is just accessing the API of the XRP ledger, there is no need to have an amendment voted on unless there is something that has to do with the code change to the layer 1. That's the only reason that there would have to be an amendment voted on. So it really all depends on the federator's need. It's not something that's released yet, I don't think.
It would be on the mainnet. It's
Okay.
they were saying maybe sometime in October they'll get it pushed out to the testnet, the public testnet, so people can start playing with it. And then, however long the amendment process takes, which could be months.
Sweet. I would be nice to know the amendment at least, just to have something to look forward to.
Oh, you can already read it. I've got it printed. It's sitting right here in front of me.
Yeah, on GitHub, you mean?
Yeah, XLS 30D.
Yeah, I have been checking it out a bit.
Automated market maker on XRPL. Yeah. David and I'm going to butcher her name. Anchal Malhotra. She did a good presentation. But yeah, you can get it. It's not the lightest reading, to be honest.
No, not at all. But I've been looking through it at least, yeah.
Been a while since I looked at math like that. But then when I was talking with David and he was like, explained it in two different ways. And then he's like, there's a third way, but you have to know differential calculus. And I was like, well, I've done calculus. It's just been a few years. And he started to explain and we got interrupted again. And it was like, okay, whatever. But when I was looking at reading through it the first time, I was like, dude, this math just smells like finance stuff. Because the finance formula is calculus. And so that makes sense.
This was
The geometric part. That's the asymmetric payoff part where it goes up and you gain more than you lose when it goes down by the same amount. I need to make sure I understand that. I don't currently. I've kind of explained everything that I am currently understanding. The liquidity pool tokens are really doing a lot of heavy lifting. I mean, I really kind of think that's the secret sauce, is the liquidity pool token. The fact that you can black hole an account, like all this is old stuff. None of that's new. It just fits the design. The market dynamics between the arbitrageurs, the liquidity consumers, and the liquidity providers, I think, are pretty balanced and fair. There's incentives for everybody to look out for their own. And, if you got two different people looking out for their own and they're not going to one of them's not going to get the upper hand and break the system. Like there's kind of a balance there. Still room for the market dynamics to fluctuate, so you got flexibility. And it really is a good design. You get rid of the impermanent loss.
Oh, I don't know. AMM sounds like the right choice for me, at least. I've had some bad trades last days.
Well, and see, the other thing with an AMM is people can be idiots and still provide liquidity, versus if you have liquidity to provide on an order book, you got to know what you're doing. You got to know how to place your orders. You got to watch it. You got to maintain it. On an AMM, you don't even have to sell. If you use an order book, you might have to sell your XRP or sell your dollars to provide liquidity. On the AMM, you don't have to sell your asset. You just provide it as liquidity. Right? So the risk profile is different than an order book. If you're only doing one-sided, yeah, you have additional fees, transaction fees, but you also are not exposing yourself to impermanent loss. I mean, there's a lot of good stuff here. Seriously.
Yeah, and this was a fun one for sure. Sorry, let me not interrupt you, Ham. So go ahead and we'll close up after.
Sure. So
I think I'm done. I'm glancing back over my notes, and I'm like, I mean, it really is, you know, and the idea that you can provide liquidity without having to put your assets up for sale, causing a taxable event, you know, that's handy.
the question that I have in regards to a single-sided liquidity pool is, you know, when you're providing liquidity, what are you being rewarded in? If you're
Liquidity pool token
tokens?
itself.
Oh, okay. And then those are exchangeable for the underlying asset?
Correct.
Man, that's fire. But that's a taxable event, right?
That when you trade from the
Yeah.
pool token back into the asset, that would be a taxable event, correct? Yeah.
Yeah, it doesn't matter if you sell the liquidity pool token for like XRP, Bitcoin, dollars, euros, whatever. If when you sell the thing, that's a thing like on an order book. Yeah, you're providing liquidity, but when you sell the thing, you've got now a taxable event. Like you've had a transaction. That's an event. So
Perfect. Answers my question. Thank you, sir.
yeah, no worries. Appreciate everybody joining. Death, you want to do the thingamajigger there at the end or wherever?
Thank you everybody for coming today. If I could ask if everyone could follow us at ledgerscale and retweet that space with the little bubble button at the bottom right there, and like the space, because this was some great information today. Hopefully other people can get this information in the future. And we love you guys. We'll see you everybody tomorrow, 3:30 Eastern Standard Time, and that is it.
Yep, and none of this is financial advice. And I know not too many people spoke up today, but speakers do not represent the ledger scale. But we definitely appreciate everybody participating and supporting us. If you want to do a donation, there's the crypto addresses for now at the top of the ledger scale account. And we'll be back tomorrow, 3:30 Eastern. Appreciate everybody. Thank you.